Hello friends, I am Sujit. I represent MoneyDhan, which is a SEBI-regulated investment advisor, one of the few companies in India which gives you conflict-free financial advice. Our advice is one-on-one, tailor-made, which suits your profile the best. In this video, we are going to talk about how to survive a market crash. To begin with, most of us have a fear of market crash. This one fear always keeps us away from committing lump sum amount of investment into stock market. Even though we all agree that share market gives lucrative returns, we are also warned how it causes instant losses. To complicate things further, no school or college teaches us anything about share market. So, many of us are clueless in this topic. People are oblivious when it comes to how to research or how to avoid bad stocks in share market. When we are not sure where to put your money, but definitely want to explore share market, there is one well-known instrument for it. That instrument is Nifty Index. This instrument is a collection of India's best, largest top 50 companies. When you invest here, India's top 50 businessmen are working for you. The best businessmen in the country are your partners. Let me tell you one big advantage of investing your capital into this Nifty Index. Now, a particular company may make big losses and go bankrupt due to number of reasons. But what about India's top 50 companies? Not all of them can ever go to zero. In fact, India is a country where large companies get larger due to their deep pockets, which help them to expand their market size. Thus, Nifty is a collection of the best companies in India. If you think India will grow, buy Nifty Index. Thus, investing becomes simpler for you. Today, we are going to discuss about how to survive a market crash. Our generation is lucky to have witnessed two major crashes. One was global financial crisis of 2008 and recent COVID-induced crash of year 2020. COVID-induced 2020 crash was short-lived for just few months. As you can see in this chart, that crash happened from 12,000 levels down till 8,000. We all witnessed this 30% drop in just few weeks. Even though this was a nightmare situation for many of us who were under lockdown, sitting at home with no source of income, there was a silver lining to the story. Fortunately, the recovery rally from 8,000 level back up till 12,000 levels came before October month end of same year 2020. Thus, COVID 2020 became a short 6 months crash and recovery affair. Psychologically speaking, crashes are much more painful when the fall in prices keeps happening and there seems to be no end to that price fall. Such a scenario tests our nerves a lot. And that one played out in year 2008 during the global financial crisis. We will talk about the most painful crash of 2008 in depth now. To start with, I will show you the ugly days of 2008. The fall kept on going for 9 long months, starting in January 2008 till November month of 2008. January month saw a 16% fall in Nifty. Investors who were hopeful of a quick rebound began to buy more to average down their losses. Market analysts were discussing subprime mortgage issues and reassuring investors that it was an excellent time to buy more. March 2008 saw another 9.3% fall. After a brief rebound rally, May and June month witnessed shocking fall of 5.7% and 17% respectively. Mind you, by now your 1 crore portfolio is worth 80 lakhs only. There is a loss of almost 20% net in 6 months. Just when you believe the pain is over, September and October month lost 10% and then a heartbreaking 26% respectively. Now the 1 crore account has lost 50 lakh in 9 months. Your new account value is 50 lakh only. The panic was real. Every day was a struggle and people were losing job left, right and center. Things during crash of 2008 were so bad that even professionally run mutual funds sign it. You can see a list of mutual funds which crashed and lost more than 50% in 2008. They all caused your 1 crore portfolio to shrink down to just 50 lakhs or below. Mind you, people have been witnessing a non-stop bull rally since year 2002 till 2008. No one was mentally prepared to witness such a crash. I am sure in today's date, if this crash were to occur, we all are sensible enough to hold the portfolio and divert our mind for few months until the worst is over. Let me show you why a 50% crash is bad in this next part. Remember my friend, losing 50% is not good. If you have invested 1 crore, 50% loss brings the value down to 50 lakh rupees. Now this 50 lakh needs a 100% rally to touch back your original 1 crore invested value. That is double efforts just to recover your losses. This is why our all-time favorite investor Warren Buffett set the rule, don't lose money. Instead of picking any single stock, you have volunteered to pick India's top 50 companies into a single basket. Therefore, you need to know this one golden rule when it comes to index investing. With the Nifty Index, even if you lose, there is always a light at the end of the tunnel. Do remember, Nifty Index never goes to zero. For that, Reliance, Tata, Adani and even SBI Bank, all of that should go to zero. Allow me to back this claim with some data. This might convince you a bit. Before the market crash of 2008, Nifty was at 6,000 levels. In 9 months, Nifty fell 50% to close below 3,000 points. But just like the mythological bird phoenix, which rises up from its own ashes, 3 years later, in the year 2011, Nifty was back to all-time high level of 6,000 once again. An amazing recovery where every investor who held on to his index position was rewarded. You must have realized by now, Nifty Index is a safe asset for you. While many of us think share market is all about betting, Nifty is a collection of top 50 companies in India. They as a cluster always generate huge profit and their market value keeps going up. Yes, crashes do occur, but they have turned out to be opportunities to buy in disguise. Check the crash in year 2000. In 3 years, Nifty made back the entire crash. In 2008, yet again Nifty Index crashed. But give 3 more years and you are back to all-time high with zero loss. In 2015-16, Nifty was very flattish with zero returns. People were not happy with the lackluster movement in Nifty Index. But in 2017, it gave 25% in 1 year, made an all-time high again. Moving on, obviously, how can we forget about 2020 COVID crash? It felt like end of the world. And now we all realize that it was an golden opportunity in hindsight. By 2023, Nifty is not only at all-time high, it is almost 100% up from 2020 levels. As a conclusion, every crash in share market is an opportunity for you. Only question is, can you hold and forget for 3 years? Always do remember, in long term, investing in a bunch of stocks is safer than staying in cash. Cash do not compensate for the inflation and taxes. That will reduce your purchase power as time passes by. While stocks seem risky at first, but give enough years and they keep growing. Please provide your feedback to this video. SEBI registered investment advisory. It is our work to have a long vision about market's next move. Please do remember, whatever we share with you here are general information. This cannot be used as an advice. Without onboarding you or having your KYC done, we cannot recommend any advice to anyone. So, if you wish to use our time, knowledge and expertise to help you out in the journey of wealth creation, please visit www.moneydhan.com.